Hello everyone. I hope this works out right for you. Like I said in the email, I've been looking at the weather all morning and decided for the seven of us that it might be easier if I just record our lecture for tonight and let you watch this from home. Like I said in the email, I'll be on my email available if you have any questions this evening, and then also tomorrow I'll be in my office all afternoon if you'd like to stop by. If those times don't work for you, please let me know, and I'm happy to work with you to find another time that we can meet if you'd like that. So what we're going to be going over tonight is a continuation on what we did last time, calculating the weighted average cost of capital for a company. We do have an assignment due next Tuesday, so a week from tonight. I'm going to briefly go over that. So it's out here on D2L. Hold on. Okay, here it's under assignment 3 on D2L. There's 3 pieces of information here. So the first one is the assignment itself, and it's going to look like what we did in the example for Coca-Cola and also the example we're working through for Westar. Except for, rather than have you look up all the information online, I'm going to give you the information and ask you to calculate the weighted average cost of capital for McDonald's. So here's what it looks like. The management of McDonald's has hired you to determine the weighted average cost of capital for the firm. They're considering introducing a new product and will use the WACC that you calculate to evaluate the project. So the project is a little silly, and it looks like this. Pro-amphibian activists have been speaking out against McDonald's neglect of amphibians on their menu. McDonald's has the McChicken, which is fowl or birds, McFish, which is fish, McRib, which is mostly pork, and of course their hamburgers, mostly beef, but no amphibians on the menu. In response to their protests, McDonald's has developed a new product, the McTurtle. The McTurtle is a sandwich that is made of processed turtle parts but no shell and is covered with a delicious cream sauce. The McTurtle has already been test marketed in Australia and has been well received. So here's your assignment. You need to calculate the weighted average cost of capital for McDonald's Corp. using the information on the accompanying spreadsheet. Just like what we're going to start off with tonight on Westar, you're going to have to make a decision about which cost of equity that you want to use in calculating your weighted average cost of capital. And that's probably going to be the most difficult thing in this project. I'm going to go over that here in a minute. So you're going to need to calculate the weighted average cost of capital. I give you a spreadsheet to do that on. Complete the PROACT model sheet, just like we did for the last assignment, to solve the problem of determining which cost of equity estimate to use. So I've given you the problem you need to fill in. You need to determine what the objective is. What is the goal of solving this problem? And this is, the next sentence here is probably the most difficult part of this. You'll need to determine a criteria to evaluate the different estimates. So you'll calculate 3 separate estimates for the cost of equity, and then you need to find a criteria to use to determine which one, if any of them, are the best choice for the cost of equity for McDonald's. So if you think back to the last assignment, I kind of gave you the criteria. Some people chose just to look at NPV and or IRR, and some people did all of the different measures that we used: NPV, IRR, MIRR, payback period, profitability index. But you were kind of given measures to evaluate the different choices that you have. Here I want you to come up with the criteria that you're going to use. Some examples I gave to the other class would be, for example, that the weighted average, the cost of equity should be greater than the cost of debt because it's riskier. So if you own stock in a company, that stock is riskier and you require a higher rate of return than if you own debt in the company. So that's one criteria to look at. Another criteria might be the return on the market overall. So let's say the long-term return on the S&P 500 is 10%, and McDonald's has historically been less risky than the market. So an upper bound of something like 10% might also be another criteria to use. But really, there's not one singular right answer for that question. There are many, many right answers. And what I'm looking for there is really just your reasoning, how you came to find some measure, some way to evaluate your different options that you're going to have. And if you have questions about that, please let me know. So what I'd like you to do is complete the spreadsheet and the PROACT model by 5:30 p.m. on Tuesday, May 3rd, so a week from today, to the assignment 3 D2L Dropbox, and we'll go over that assignment in class on that night. I'm going to go back now to the other items I had on here for your assignment 3. So here's the spreadsheet. And I give you all of the information that we kind of have in class for the other 2 examples we're looking at. The current price at the time I made this up for McDonald's stock was $125.79. The dividend yield is 2.8%. The analyst estimates for growth is 9.81%. The beta for the firm is 0.50, so it has half the market risk of the average firm. The risk-free rate's 1.86%. The market risk premium is 5.62%. The market value of equity is $110.20 billion, and then so on. I won't read through all these. And then I give you the historic dividends. And what I want you to do on this spreadsheet is to fill in these. So give me the discounted cash flow using the historic dividend growth, just like we did it in class. The discounted cash flow using analyst estimates. The cost of equity using the security market line. The cost of debt estimate, again, the information you need is up here. And the after-tax cost of debt estimate. Calculate the weight of debt and weight of equity in the capital structure. And then tell me which one you ended up using for the cost of equity. And so that's why the reason for this is when I'm grading your assignment, I'll put in my answer key your estimate, which one you used, and so it'll calculate the weighted average cost of capital you should have gotten. So I'm just asking here, which one did you use? And use the PROACT model to explain your choice. And then the final question is, would you use the weighted average cost of capital calculated above to evaluate the project presented in the instructions? I'd encourage you to go back and look at your notes that we went over last time to think about this question a little bit, and then explain why not. And when you're done with that, save it and upload it to D2L. The last item is the PROACT model. And again, what I'm asking you to do with the PROACT model is to determine to make the decision of which cost of equity you should use. So you'll need to fill out the problem, the objective, the alternatives, and in the consequences, tell me the criteria you're using to evaluate the different options that you have. If you have questions about that, let me know. And then finally, the trade-off and analysis, and explain why you used the estimate that you used. So that's it for the assignment. What I want to do now is go back to what we were working on last time, and that was the weighted average cost of capital for Westar Energy. Where I'm going to pick up is where we were looking at the different cost of equity for Westar. So we had calculated the 3 estimates for the cost of equity, and just to briefly go over these. We had calculated for the first one, so this would have been the discounted cash flow model, which is the dividend yield plus the growth rate. Well, we got the dividend yield, just it's provided on the tear sheet, and that's 3% right here. We calculated the historic growth rate in dividends using the past 6 dividends for Westar. And that gave us an average annual growth rate of 3.037%. And so we added the dividend yield plus that growth rate that we calculated to get a cost of equity estimate of 6.037%. And I had a really great suggestion after class. Someone, student in class, suggested that we use a subscript to designate which growth rate we're looking at. So I'm going to use that here. And this was the historic growth rate. So G in this case would have been GH for historic. And then the next one is the cost of equity plus the growth rate based on analyst estimates. And we looked that up on Capital IQ, and the analyst estimates for growth were 5.42%. So GA for analyst estimates would have been 5.42%. So our cost of equity would have been the dividend yield of 3% plus the expected growth rate based on the analyst estimates of 5.42%, giving us a cost of equity of 8.42%. So those are the 2 discounted cash flow approaches that we went over in class last time. The third approach is the security market line approach. And the security market line says that the cost of equity is equal to the risk-free rate plus the beta for the firm multiplied by the market risk premium. And so our risk-free rate was 1.8%. Our beta for Westar was 0.35, and the market risk premium was 5.49%. And I gave you, these were given numbers that we didn't look up, the risk-free rate and the market risk premium. So if we calculate that, we take 0.35 multiplied by 5.49 and add to that 1.8%. So our outcome is 3.72% from that. So we have our three estimates: 6.037%, cost of equity of 8.42%, and the cost of equity of 3.72% using the security market line. So now what I want to do is move on to the cost of debt. So R sub D is equal to, sorry about that, is equal to the yield to maturity on the firm's long-term debt. And there's several different ways actually to calculate the cost of debt, but this is the most typical way. If you can find the yield to maturity on the firm's long-term debt, it's really the best because that is the market required rate of return that we can access and see what's actually in the marketplace and the required rate of return based on what investors are doing. Some people take a weighted average of long-term and short-term debt to find the cost of debt. For our purposes, though, we're looking at long-term projects. So because we're looking at long-term projects, we want to use debt that is going to match those long-term requirements. So I'm going to go back out to Capital IQ here and look up the cost of debt for Westar. So I'm out here on Westar. I'm going to go to the fixed income, where it says fixed income in summary. You don't have to do this for your assignment, but I did want to show you the tools that we have available if it's something that you're interested in. So what's nice about Capital IQ is that it gives you these benchmark securities. So we have a debt for Westar that matures in about 10 years. And the yield to worst, so that's either the yield to call or the yield to maturity, but it's the one that gives us the lowest yield of those two, is 2.666%. So we're going to use that number, 2.666%, for the required rate of return on the debt of Westar Energy. And you can scroll down below and you'll see where they have actually all of the outstanding debts for Westar. But I'm going to use this cost of debt, and then I want to look up the corporate tax rate. So I'm going to go out here to the income statement, and I'm going to look at what they paid in the last year and also compare that a little bit to what they've done in the past previous to that. So I'm scrolling down here to where it says effective tax rate, and it says these are all the past years. And what it shows here is that the most recent year, the corporate tax rate was 33.5%. So that's what we're going to use for our calculations too. I'm going to switch back over to the document camera. So I've got the yield to maturity on the firm's long-term debt, and that was 2.67%. And the corporate tax rate is T sub C is 33.5%. So the after-tax cost of debt, it's RDT is equal to the pre-tax cost of debt, which is RD, it's the pre-tax cost of debt, multiplied by 1 minus T sub C, which is T sub C is the corporate income tax rate. That's the corporate income tax rate. My handwriting is not the best there. So I'm going to calculate that now to find out the after-tax cost of debt, RD, R sub DT. and that is 0.02666 multiplied by, open parentheses, 1 minus 0.335, close parentheses, press enter, 1.77289. 1.77289%. Okay. So now what we're going to do is calculate the weights. We've got the cost of equity, we've got the cost of debt. Westar, like most companies, doesn't have any preferred stock, so there's nothing to include there. So now we're going to calculate the weighted average, the weights of the different pieces of capital in the capital structure. So I'm going to go back out here to Westar, and I'm going to go to where it says capitalization. Looking at the wrong place. Here we go. So it says capitalization. I think it's under this. It's either under this or capital structure, so we'll see. Yeah, this is what we wanted. So we want the market cap, or the market value of the firm's equity, and we want the total debt. And the total debt in Capital IQ is the total interest-bearing debt. So that's what we're looking at, it's the total interest-bearing debt. I'm going to go out here to the most recent time period, and their capital structure looked like this. The value, the market cap of equity, market capitalization, is equal to 6.551 billion, and the amount of debt that they have is 3.580.7 billion. All right. So going back out to the document camera, I've got my market cap, and that's 6.551 billion. So this is equity. This is debt. So I want to find my total capital. So I'm going to add those two together, and that will give me 6.551 plus 3.5807 gives me total capital of 10.1317. Okay. So now I calculate my weight of debt is equal to my amount of debt, 3.5807 divided by 10.1317 gives me a weight of debt of 35.34% or 0.3534. And my weight of equity is equal to the 6.551 divided by the 10.1317. So the market value of equity divided by the total capital. So I take 6.551 divided by 10.1317 gives me an answer of 0.6466. And those sum together for 1, and they have to sum together to make 1, otherwise there's something wrong with your estimate. So now we've got 3 different options for the weight of equity, and we've got the weight of debt, or the 3 different options for the cost of equity, an option for the cost of debt, and then the weights of debt and equity. So our last decision we have to make is which cost of equity are we going to use? And that's going to be really, I think, the challenging thing about your assignment is coming up with some rationale to use. So for me, looking at this, we have our 3 cost of equity that we went over before. One of these I can almost automatically throw out. So I'm looking at this and I see that debt holders are requiring a 2.67% return on the debt of Westar. Well, then there's only barely a 1% difference between the required rate of return on the firm's debt and the required rate of return on the firm's equity, which is honestly a little low. Typically, what we would normally see here is a range of 3 to 4% difference. So if I'm looking at this number here, and I'm adding 3% to that, I'm at 5.67%. If I'm adding 4%, I'm at 6.67%. And where that comes from is this idea that the debt holders take on a lot less risk than the equity holders for the firm. So the equity holders should get a higher return, and it should be a measurable difference. So I would throw out in this case the CAPM model estimate because it's really low, and it doesn't make sense looking at that and trying to come up with an answer. So I would knock that one out. I think you could justify either the 6%, 6.037%, and from the point of view that is, almost around 3.5% higher than the cost of debt. So that one kind of makes some sense. You could also justify the cost of equity using the expected return based on the analyst estimates plus the dividend yield. So for me, I don't know if I'd call it risk right now with Westar, but there is a situation where they're looking at maybe being taken over or purchased from another company. There's a little bit of risk involved in that with the stock price. You're going to see some volatility out of that. Honestly, if I'm grading this assignment and you're giving me good criteria for either one of these, I think either one is acceptable. But there is a fairly large difference between the two. So in my example here, I'm going to use the second one. I'm going to use the 8.42% as my cost of equity. So I'm going to say the cost of equity, RE, is equal to 0.0842. And so now I have my weights, I have my cost of debt and equity, and I can calculate the weighted average cost of capital. So the weighted average cost of capital says that it's equal to the weight of debt multiplied by the after-tax cost of debt plus the weight of preferred stock, that's the P, multiplied by the cost of preferred stock, that's RP, plus the weight of equity or common equity multiplied by the cost of common equity. For Westar, and again, most companies, this is nothing. There is no preferred stock. So we're going to just put zeros in for that. Our weight of debt, get from over here, was 0.3534 multiplied by the after-tax cost of debt of 0.0177. We'll stop with that. Or add a 3 there. Plus 0 multiplied by 0 plus the weight of equity. Our weight of equity was 0.6466 multiplied by the estimate we're using in this case, 8.42%. All right, so I have my weight of debt multiplied by the after-tax cost of debt plus the weight of preferred stock multiplied by the cost of preferred stock plus the weight of equity multiplied by the cost of equity. So I'm going to put that in my calculator here, and I'll get 0.353. Let me clear everything out a little bit better. Okay, 0.3534 multiplied by 0.01773 plus 0 plus 0.6466 multiplied by 0.0842, and I get 6.07%. Okay, so I hope that helps you out with your assignment. Please let me know if you have any questions about how I did these calculations. Again, we worked through two companies. We did the weighted average cost of capital for Coca-Cola, and then just to run through another example for you, I did Westar also as an example. The next topic we're going to talk about in this lecture is moving on then to the next set of notes, which is the capital structure notes. So I'm going to pull those up here. and they're out online, and I need to make one correction to them. But I'll go ahead and pull it up, and I'll, let's see, they're out here in content, and under leverage and capital structure, gotta download these. Here we go. And I'm going to type in the notes to save you from having to try to read my handwriting. So when we talk about leverage and capital structure, we're talking about how the firm pays for its assets. So we think of a balance sheet and the accounting equation, and we see on the left-hand side is the total assets of the firm. On the right-hand side, we explain how we paid for those assets. So because the value of the firm is maximized when the weighted average cost of capital is minimized, the optimal capital structure is the mix of debt and equity that minimizes the weighted average cost of capital. When calculating the weighted average cost of capital, we're not trying to calculate the lowest weighted average cost of capital. We want to, as I explained in our last class, we want to get the most accurate weighted average cost of capital so we make good decisions. But when choosing capital structure, we want to choose the capital structure, the mix of debt and equity, that gives us the lowest weighted average cost of capital, because that maximizes the value of the firm and eventually the value of the firm to the stockholders. So we're going to look at a situation here where we have a current situation where we have no debt, and we have a proposed situation where the firm is going to take out $500,000 in debt, and they're going to repurchase stocks. And this is very common for them to do, not to that degree, but we saw it with Coca-Cola about 6 or 7 years ago. We saw it with Pepsi. We see with actually a lot of companies out there. Microsoft did it about 10 or 12 years ago. Actually 12 years ago, a very large repurchase of stocks. So going out and repurchasing stock and taking out debt to repurchase stock is a very common thing. So the situation we're looking at is common, although the degree to which our proposed company is doing it is much larger than most would. So we have our current situation, no debt. We have our proposed situation where the company goes out and takes out a loan for $5 million and repurchases $5 million worth of stock, leaving the total equity of the company at half its former value of $5 million, and then making up the rest of the cost of the assets with debt. So in our current situation, we have no debt. Our debt to equity ratio, our debt ratio is nothing because there's no debt. Our debt to equity ratio is 0 because there's no debt. Our share price is $25 per share. Our shares outstanding is $500,000. And the correction I need to make here is the interest rate shouldn't be 5% because it won't match up with the rest of the examples that I give you. It should be 8%. So I'm going to change the interest rate from 5% to 8% here. And now we need to calculate what our shares outstanding would be after we repurchase $5 million worth of stock. So to do that, I'm going to switch over to the document camera here, and we're going to say we're taking out $5 million in debt, and we're going to repurchase stock with that, and the stock costs us $25 a share. So we would go out to the marketplace and we would repurchase $5 million in debt, $5 million in stock at $25 a share. So the number of shares of stock we would repurchase would be 200,000 shares. So we started off with 500,000 shares. And so our remaining number of shares would be 300,000. So again, we start with 500,000 shares. We're taking $5 million and we're repurchasing shares with that $5 million. So we would repurchase 200,000 shares, and so our remaining number of shares outstanding would be 300,000. Okay. we're going to use that number in our later calculations. So our first scenario is a situation where we don't have any taxes, and we have no debt and no taxes. So our net income is our earnings before interest and taxes. So this is the earnings after we've taken out all our cost of goods sold and all our salaries and depreciation and all that stuff. And we subtract out interest from that. Since we don't have any debt, we don't have any interest. So our net income would be $500,000 for the first situation, $1 million in our second situation, and then finally $1.5 million in our third situation. Our return on equity is our net income divided by the amount of equity we have. So we have $10 million in equity, so we would divide our net income by our total equity of $10 million. So our net income is $500,000 divided by 10 million. So we have 5% return on equity. So our return on equity in the first case is 5%. In our second case, make this look a little better too. Our second case, we have $1 million in earnings. So our return on equity would be $1 million divided by the $10 million in equity we have, or 10%. And then in our third case, we have a net income of $1.5 million, and our return on equity would be the $1.5 million divided by the $10 million, or 15%. Finally, the earnings per share are the net income divided by the number of shares outstanding. So in the first case, we take 500,000 divided by 500,000 shares. So our net income is $500,000 divided by 500,000 shares. I won't even break out the calculator for this one. It's going to be $1 per share. In the second case, it's $1 million divided by 500,000 shares. So that's going to give us $2 per share. And in the third and final case, it's $1.5 million divided by 500,000 shares, or $3 per share. So that's with no debt, no taxes, and that's our outcome. In the second situation, now we're saying we're going to take on 50% debt. This situation here, so our debt ratio up here is 0.50, and our debt to equity ratio, so that's our amount of debt divided by our amount of equity. Our debt to equity ratio would be 5 million divided by 5 million, or 1.00. Okay. So our interest expense, and this is why I needed to change this to 8%. Our interest expense is going to be 8% of $5 million. So that is equal to 400,000. So I take 0.08 times $5 million, and that gives me 400,000. So my interest expense here is 400,000. And it's important here to note that that does not change. So no matter the state of the economy, recession, expected or normal economy, or an expansion, my amount of interest expense is the same no matter what. So with interest expense of 400,000 for each situation, our net income in the first case would be $500,000 minus the 400,000 in interest, or $100,000. In the second case, it would be $1 million minus $400,000, or $600,000. And in the final case, it'd be $1.5 million divided by $400,000, or 1.1 million. For the ROE, so our equity in this case is the new amount of equity of $5 million. And so $100,000 divided by $5 million is equal to 2%. So I'll go back out here. The 600,000 divided by $5 million is 12%. So, and then finally, in the last case, the $1.1 million divided by the $5 million is 22%. For the earnings per share, we're going to take the net income divided by the number of shares outstanding of 300,000. So in the first case, it's 100,000 divided by 300,000, or 33 cents. In the second case, it's 600,000 divided by 300,000, or $2. And in the final case, it will be the 1.1 million divided by the 300,000 shares. Divided by the 300,000 is equal to $3.67 per share. All right. So our next page, we're going to go into another theory about capital structure, which will include interest. But what I want you to see from the previous example here is the addition of debt to a capital structure increases, and the correct answer here is volatility. It increases the volatility, the change in ROE. So here we have 5% to 15%, and here we have 2%, 12%, and 22%. So a wider range of ROE, a wider range of EPS from 33 cents to $3.67. And what you should also see here, at least in terms of earnings per share, that if the company doesn't do as well, if they're in recession, then the company with the debt does not do as well for the stockholders as it does with no debt. But there's an increased value added to the stockholder if they're expanding, if the company's doing very well. So here's just a graph of the earnings per share with and without debt based on the EBIT, the earnings before interest and taxes. And so we see here what's called the break-even EBIT. And I'm going to demonstrate how to calculate this. So for the break-even EBIT, the calculation is a little bit different. We have our EBIT divided by shares outstanding with no debt, EBIT minus the interest expense, divided by shares outstanding with debt. So for our example, so now I'm going to calculate the break-even EBIT, and the equation was EBIT without debt is equal to, or divided by the number of shares outstanding without debt, is equal to EBIT minus the interest expense divided by shares outstanding with debt. There's no debt. Okay. So EBIT is my variable. I'm going to leave that in my equation, and that's what I'm solving for. So I have EBIT divided by 500,000, because that was our shares outstanding with no debt, is equal to EBIT minus $400,000, because that was our interest expense, divided by 300,000 shares, because that's how many shares we had left over after we took out debt and repurchased 200,000 shares. So now I want to solve for EBIT. So in order to do that, I'm going to cross multiply each side here. So I'm going to have 300,000 EBIT is equal to 500,000 EBIT minus, and if I multiply 500,000 by 400,000, I get a 2 with 11 zeros after that. So I'm not going to do that. I'm just going to put 500,000 multiplied by 400,000. And now what I want to do is move my EBIT numbers all to one side and then move this other number to the other side. So that's going to give me, I'm going to subtract 300,000 EBIT from both sides, which will give me 200,000 EBIT. Is equal to, and then I'm going to move this number over to the left-hand side. So it's negative, I'm adding 500,000 multiplied by 400,000 to both sides, or to the other side. So I have 500,000 multiplied by 400,000, and that is $400,000. So now I'm going to divide both sides by 200,000. So I have 500,000 multiplied by 400,000. Gives me a really big number. I'm going to divide that by 200,000. And that gives me an answer of $1 million. And that is my break-even EBIT. So what does that mean? What does break-even EBIT means? What that means is that above the break-even EBIT, I'm better off issuing the debt and giving an additional bonus to my stockholders. Below the break-even EBIT, I'm better off not taking on the additional debt because my stockholders will be impacted more heavily by the losses than they would if they had no debt. So then what I want you to take from that is that as we add debt to a firm, we concentrate the profits and the losses onto fewer and fewer shareholders. And so those remaining shareholders feel it more severely. Okay. So the answer here was that the break-even EBIT was equal to $1 million. And that is the case with no taxes. Now, as we move on, though, we're going to add in taxes. We're going to see that it does have a big effect. So M&M are Modigliani and Miller, and you'll hear about them quite a bit in finance. Their name is Modigliani and Miller, M&M for short. They had a lot of theories about capital structure and a lot of theories about dividends and how those are paid out. So the first proposition from Modigliani and Miller is called the pie model, according to your textbook. And the idea of the pie model is that you as an investor can create your own leverage for the firm. So if we go back to our original example where the company didn't have any debt, you could put debt onto the company by how you invested it or at least get the same results by taking out debt to invest in the company or to buy the company's stock. So let's say the company has no debt, but you want the greater upside if they had taken on debt. And so what you would do in this case is let's say you want to buy $100 worth of the stock in this company, you'd go out and take out a loan for $50, and you'd use $50 of your own money, and you would buy the stock of the company, and that would give you the 22% return. If the economy was in an expansion, and the earnings per share of $3.67 after you paid the interest on that debt that you had taken out to buy the stock in the company. So that's the idea behind the pie model, is you can create your own leverage for a company. You can leverage a company, the investment, up on your own. So there's no need for a company to take out any debt, because the investor can individually decide how much leverage that investment should have. Now, that ignores taxes and a whole bunch of other things, but that's kind of where they started. Their second proposition, called M&M2, and we're going to give it another name here in a minute, they made a lot of assumptions. They assumed that there were no brokerage costs, in other words, no commissions, no taxes, no bankruptcy costs. And so what that means by no bankruptcy costs is it means that there are no costs associated with lawyers and accountants, and no court costs by going through the act of bankruptcy. And there was no cost from liquidation either. So you get what, if you were to liquidate the company, you wouldn't have to pay anyone to do that, and you would get what the assets were actually worth. Okay, so that's what no bankruptcy cost means. Individuals borrow at the same rate as corporations. That's not necessarily true, but it's an assumption they had to make for this. There are no information asymmetries, and EBIT is not affected by debt. We're going to come back to that idea later on, because in most cases, EBIT, the operating earnings of the firm, is not affected by the debt they have. But there are some unique and very important cases where it is. So based on their second theory, their second proposition, the cost of equity is determined by the required rate of return on the firm's assets. So how risky are the firm's assets? And the rate of return, the required rate of return on the firm's assets, is denoted with R sub A. The firm's cost of debt is R sub D. And the debt to equity ratio is D over E. So according to this theory, the required rate of return on equity for a firm is equal to RA, the required rate of return on assets, the difference between R sub A and R sub D, multiplied by the debt to equity ratio of the firm. So if a company had no debt, the required rate of return on equity is simply the required rate of return on the firm's assets. The required rate of return on the firm's assets is determined by the business risk of the firm. And there are a lot of sources of business risk. It's the uncertainty in the projection of the firm's cash flows. And it depends on demand variability. So how much does demand change from year to year for the company? Sales price variability. Does the sales price, the price that they can sell things, vary a lot from year to year? Input cost variability, so how much do their input costs change, over time? And really, this next one is really key: the ability to adjust output prices for changes in input costs. So let's say I have a lot of input cost variability, but I have the ability to change my prices. Based on that, I don't face as much business risk as if I can't change my prices based on my input costs. So, for example, if you think about farms, the market sets the price for farm goods. So if you're going to sell soybeans, for example, if you're a farmer, you don't get to determine the price that those soybeans sell at. You either sell them at the market price or you don't sell them at all. So it doesn't matter what your costs were in putting those soybeans in the ground, fertilizing them, taking care of them, watering them, getting them all grown up, harvesting them, and then getting them to the market. Your costs don't matter. The only thing that matters is the market price. So you face a lot of business risk if you've had a bad year, if you've had additional cost in getting your product to market, if you cannot adjust the prices for your cost. The next one is the ability to develop new products in a timely, cost-effective manner. So there are some companies that really rely on this, and one example would definitely be Apple Computer. They need to come out with a new iPhone every year or two. If they don't, then people are going to stop buying their phones. They're going to go over to Samsung, who has a new phone that year. So a lot of companies really do rely on that to reduce their business risk. The foreign risk exposure, this is buying and selling or having markets overseas. So you're going to face the economic risk of being there. Their economies may go sour while the United States economy is doing very well. The exchange rate might change. We've seen a lot of changes in exchange rates, foreign exchange rates recently. And so that's another business risk that you face. And finally is operating leverage. And operating leverage is the use of fixed cost. So the use of fixed cost for a firm, not including interest expense, and that we refer to that as financial leverage. But operating leverage are things like salaries for your managers, paying rent on buildings and land and equipment, and things like using a lot of machinery or equipment in your company. This is a situation that happened with Ford and GM back in the mid-1990s. Ford decided to automate their plants, and so they went from using a lot of variable costs, and those would be people. So if sales of their cars and trucks were down, they could lay people off, they could send them home, they could reduce their variable cost of labor. When they decided to automate a lot of their factories, they turned those variable costs into fixed costs. And you might say, well, that doesn't make a lot of sense because they're taking on a lot more risk. That's true, but they also reduce their overall expected costs because the machines were less expensive to have and to maintain and to use than the people were that were building cars. So we'll oftentimes see companies switch from variable cost to fixed cost in order to reduce cost, but they run the risk of having a bad year and still having to pay those fixed costs where they could have had variable costs that they could have automatically reduced. So those are some things that increase the business risk of the firm. And I don't want you to memorize all those for as a list for the exam, but get an idea of what causes, what companies look like that have a lot of business risk. And we can talk more about that later too. But business risk is determined by management decisions and industry characteristics. The cost of equity here is determined by the firm's capital structure. So the second part of this, so we have the RA, R sub A, so that's just the riskiness of the firm's operations, okay, and their assets. Then we have the effect of the capital structure over here. As a firm increases its debt, the business risk becomes more concentrated on the stockholders. And that's what I showed you in the example above. When we added debt to a firm, it got more risky for the stockholders, but also with a greater reward. If the assumptions of Modigliani and Miller number 2 proposition are true, then the firm is not affected by capital structure. And what they say is capital structure, or firm value is not affected by capital structure. What they say is capital structure is irrelevant. It's irrelevant. It doesn't matter in the effect on the value of the firm itself. Okay, so we refer to this, it's not this way in your textbook, but it's commonly referred to as the irrelevancy theory. So after we talk about business risk and the addition of business risk and how that affects the required rate of return of the firm's equity, the next thing we take a look at is corporate taxes and capital structure. And taxes are incredibly important. Right now I'm working on a paper examining the differences between the capital structures of for-profit hospitals and not-for-profit hospitals. And the major difference between the two is the fact that for-profit hospitals have to pay taxes. Not-for-profit hospitals don't pay taxes, and that actually results in a very large difference in the capital structure, the amount of debt that the two take on. For-profit hospitals take on a lot more debt than not-for-profit hospitals because there's this thing called an interest tax shield for firms that pay taxes. Not-for-profits don't pay taxes. So according to Modigliani and Miller, the present value of the interest tax shield for a firm is equal to the firm's corporate tax rate, T sub C, multiplied by the dollar amount of the firm's debt. So the present value of the interest tax shield, so this would be the present value of all the future annual benefits from that tax shield, is equal to the corporate tax rate multiplied by the number of dollars of debt that the firm has. The interest tax shield increases cash flows available to all the firm's investors. So our second scenario here, we're using the same basic idea from the first one, but now we have a 40% tax rate. So in the first case, we have no debt. And so in these situations, our interest expense is just zero across the board. Our income taxes then, our earnings before tax are just the same as our EBIT, our earnings before interest and tax, because we don't have any tax expense. And so our income tax is going to be 40% of our EBT. So in the first case, it's going to be $200,000. In the second case, it's going to be $400,000. And in the final case, it'll be $600,000. And I just got this by multiplying 0.4, the tax rate, multiplied by EBT in each case. So our net income is EBT minus the income tax. So it's $300,000 in the first case. The second case, it's $600,000. And in the final case, it's $900,000. And again, I'm just taking EBT minus the income tax to get the net income. Our return on equity is the net income divided by the amount of equity. We scroll back up to page 1, or way back up here. So our equity in the no debt situation was 10 million. With the debt was 5 million. So I'm going to put in 10 million here. So our ROE is 300,000 divided by 10 million, and that gives me 3%. I'll make this look a little bit better here. The second case, it's 6%. Again, it's 600,000 divided by 10 million. And then in the last case, it's 9%. My earnings per share, if you remember, my number of shares outstanding are 500,000 shares. So I take my net income divided by my number of shares outstanding. So I have my net income in the first case, and I have already forgot it. Let me go back out here. My net income in the first case, I'll just pull my calculator to the side, was 300,000. So I take 300,000 divided by my number of shares outstanding of 500,000. So it's 0.6. So my earnings per share are 60 cents here. The second case, I'm going to take 600,000 divided by 500,000 shares. So it'd be $1.20. Now, last case, it's going to be 900,000 divided by 500,000 shares, or $1.80. Okay. Down here, we have 50% debt. My earnings before taxes in the first case is going to be $100,000. So I take EBIT minus the $400,000. The second case is $600,000. Again, I'm taking 1 million minus 400,000. And in the last case, it's 1.5 million minus 400,000, or $1.1 million. My income taxes then are 40% of my EBT. So 40% of $100,000 is $40,000. 40% of $260,000 is $240,000. And then 40% of $1.1 million is $440,000. So again, I'm just taking 40% of my EBT. So my net income is the difference between my EBT and my income taxes. So I take $100,000 minus $40,000, gives me $60,000. $600,000 minus $240,000 gives me $360,000. And then finally, 1.1 million minus $440,000. I'm going to use my calculator just to make sure I give you the right answer. Gives me $660,000. So my return on equity, remember in this case now our equity is $5 million instead of $10 million. So I'm going to divide my $60,000 by $5 million. So $60,000 minus $500,000 gives me 1.2%. $360,000 divided by $5 million gives me 7.2%. And then finally, $660,000 divided by $5 million, gives me 13.2%. Then finally, my earnings per share are my net income divided by my shares outstanding. For the case with 50% debt, my number of shares outstanding are 300,000. So I'm going to go through and I'm going to divide each of those by $300,000. So I take $60,000, or 300,000 shares, not $300,000. So I take $60,000 divided by 300,000 shares gives me 20 cents per share. The second case is $360,000 divided by 300,000 shares would give me $1.20 per share. And the last case is $660,000 divided by 300,000 shares. Gives me $2.20 per share. Okay, so we see kind of the same outcome that we saw in the first case, except for our range is a little bit different because we do take out the effect of taxes. So we have the same outcome in terms of earnings per share, $1.20 at our break-even EBIT of $1 million. We do better off with the debt if we're a stockholder if the economy does well and we sell more. We do worse if the economy doesn't do well and we don't sell more. So what I want to show you here is the effect of the tax shield on the expected outflows to investors. So what I'm using here is the expected outcome. So that middle column here and here. So our cash flow to stockholders, if there's no debt, is our net income. We're paying everything out. So it's $600,000 to stockholders if there's no debt. And bondholders get nothing because there's no debt. So the total amount is $600,000. If we have $50,000, 50% debt, our cash flow to stockholders is $360,000. The cash flow to our debt holders is $400,000. And so the total here would be $760,000. So the interest tax shield, or kind of the cash flow from the interest tax shield, is the difference between the two. So we actually generated, for all of our investors, not just stockholders, but stockholders and bondholders, we generated $160,000 more in cash flow because we didn't pay taxes on that $400,000 that we sent out to the bondholders. So our tax shield was worth, for that single year, the tax shield was worth $160,000. So higher tax rates make debt more attractive to firms than lower tax rates. And that's where I'm going to end our lecture for tonight. And then next time we're going to pick up the remainder of, well, probably not get all the way through, but we will talk more about capital structure on Thursday night. So again, if you have any questions about this lecture, please let me know. And I'm happy to go over it with you one-on-one if you would like. All right. I will see you on Thursday night. There'll be some quiz questions over the lecture that I've put out there online tonight. Okay.